For the balance sheet, there is different logic. The balance sheet doesn't have a top-down. We go straight into the detail level, and when we copied the previous year's balances into the balance sheet, we don't copy July to July, December to December, etc. We copy the closing balance from the previous year into every month as a starting point. The logic behind that is that if you ended the year with $100,000 in the bank and you didn't do any trading in the next year, you would close the end of the year with $100,000 in the bank. So we use that as the starting point. At the beginning, every month will be the same value. It'll be the same value as the closing balance at the end of the previous financial year. The idea now is that you actually make the adjustments necessary to that closing balance to reflect the business that you expect to do in the budget year. The first thing that we would do is probably go to the debtors, go into a total view, and what we could do in the debtors is actually enter a key performance indicator value. So here we're going to budget, instead of 69 days, I'm going to try and budget for 45 days on average. And you'll notice it recalculated the receivables value, and it no longer agrees with the roll-up value. It also now has caused my balance sheet to go out of balance. So if I go down to the bottom of the balance sheet, my variance roll-up now does not agree with the total of the budgeted detailed accounts. We then continue with the inventory, and once again we actually have the option of putting in the number of inventory days. I'll make that 100 days inventory, save that, and then we actually would go to the accounts payable and we would actually make an adjustment there using the KPI value once again. Once we've done that, we've now got the three balance sheet driver values established. The next thing is to then reflect changes that you expect to happen in the business. So changes in short-term debt, changes in liabilities. If you're going to buy a motor vehicle, you actually may add to your current assets, and so on. So you make all of the adjustments in the month that you anticipate making those changes to your business. Eventually you'll get to the end of reflecting those changes, and the balance sheet will be totally out of balance, positively or negatively. So what we do, we then go to the bank account. We need to go back to the detailed view of the bank account, choose the account that we want to use as our balancing item, and this time we say balance to the variance, and this will add or subtract the balance sheet variance row to the bank account. Click OK, and now click Save, and we've now balanced the budget. The logic in doing that is that any change in the budget in the balance sheet somehow affects the bank account. If we spend money on an asset, it takes it out of the bank. If we generate money by reducing inventory or reducing our receivables, it goes into the bank account. Once we save this budget, we now have a saved balance sheet and profit and loss budget. So from that basis we can now do cash flow forecasting and forecast KPIs. Thank you.